The decision between sole trader and limited company affects everything from your taxes to your personal finances. It's one of the first major decisions you'll face as a business owner. Both have their advantages and disadvantages, but choosing the right one depends on how you want to run and grow your business. My name is Rehan Moghul. I'm a chartered accountant and founder of Sidekick Accounting. In this video, I'm going to help you decide whether being a sole trader or operating as a limited company is best for you and your business. Let's start with the core difference. As a sole trader, you and your business are the same legal entity. This means any profit you make is considered your income, but it also means any debts and liabilities are your personal responsibility. In contrast, a limited company is its own legal entity which is separate to you. The company owns its assets, earns its income, and takes on its own debts. If something goes wrong, your personal assets are generally protected. So sole traders are personally liable for everything, while a limited company offers additional protection by separating your personal and business assets. Next, let's talk about control and risk, which are two key factors when deciding between the two. As a sole trader, you have full control over your business. You make all the decisions and everything you make is yours after taxes. This simplicity makes it attractive if you're just starting out or if you just want a more straightforward setup. But with that control comes risk. Because you're personally liable for all of the business's debts, if something goes wrong, like a bad contract or a legal issue, you're personally liable and your home and savings could be at risk. With a limited company, you're protected by limited liability. This means if your business does run into trouble, your personal assets are protected. However, you don't have as much control over profits. The company earns money and you need to decide how you pay yourself that personally, usually through salary and dividend. While you're still in control as the director, the business operates more formally. There are stricter rules around what you can and can't do. Another key consideration is flexibility. Sole traders have a much more flexible setup. There's less paperwork, less admin, and typically you just need to file a tax return once a year. This flexibility is great to get things going and keep things moving quickly. But sometimes being a sole trader can make your business appear smaller or less established, especially when dealing with larger clients and suppliers. With a limited company, there's always more admin. You need to file a set of year-end accounts, a corporation tax return. Typically, you need to keep much better records, and you often need an accountant to help you with it. However, having limited after your business name often gives a more professional and stable image. It can be a big advantage if you're looking at working with bigger clients or investors. Now let's talk taxes, because this is where things really get different. As a sole trader, any profits you make are considered personal income, and you'll be taxed on that income at personal tax rates. Depending on which band you're in, that ranges from 20% to 45%. On top of that, you'll pay Class 2 and Class 4 national insurance contributions, which can add up very quickly. The upside here is simplicity. Everything flows to you and your taxes are relatively straightforward. With a limited company, the tax setup is more complex, but often more tax efficient. The company pays corporation tax on its profits at rates of between 19 and 25%. Then as a director, you choose how you pay yourself. You can take a salary, which is taxed as if you were in any other job. You can take dividends, which is the same as if you held shares in Apple or Meta, or you can choose a combination of both. The next question is, why would you bring dividends into the mix if you can just pay yourself a salary? Because dividends are taxed at a much lower rate than your salary, typically between 8.75% and 39.35%, depending on how much you're paying yourself. Plus, the first £500 of dividends are tax-free. Paying yourself a salary and dividends can significantly lower your tax bill compared to a sole trader who is paying straight income tax. However, this tax-saving strategy requires a little bit more planning and often the help of an accountant to run payroll and make sure everything adds up. Next, we should weigh up the cost versus the growth potential of your business. When it comes to scaling and growing and even exiting your business, the right setup plays a huge part. As a sole trader, your growth is often limited by what you can fund yourself, whether that's from personal savings, a personal loan, or reinvesting business profits. It's harder to attract outside investment because you can't sell shares in your business. It's legally tied to you. Banks may also view sole traders as more risky, which means it's more difficult to get favorable terms or to get a larger loan. In contrast, a limited company opens up more opportunities to raise funds. You could choose to sell some shares to an investor, bringing in cash without relinquishing control. Investors typically prefer limited companies because of the clearer legal structure and limited liability. Both of those things help to scale a business quicker. Banks and lenders are also more likely to offer favorable terms and larger loans to a limited company thanks to its financial transparency. Another point to note is when it comes to exit planning, a limited company offers much more flexibility. You can sell some shares or you can sell all the shares in the company, allowing for a gradual exit or just a complete handover. A limited company also opens up the doors for much more tax planning when it comes to exit. That means you could effectively end up paying 0% tax rather than personal capital gains. If you're just starting out, want to keep things simple, and you don't plan to scale rapidly, a sole trader might be the best option. The setup is easy, there's less paperwork, and it allows you to just get running with your business without worrying about admin and formalities. On the other hand, if you're thinking long-term, want to protect your personal assets, and like the idea of potentially selling or bringing in investment, a limited company may be the route for you. While there's more admin and cost involved up front, the limited liability and the potential for lower taxes might just make that the best option for you, especially if you're planning to grow your business. If you found this video helpful, give it a thumbs up below and subscribe to my channel for more tax saving content.